All right, let's get straight to it. The Fed gave us the dovish cut we expected, but what's hiding under the surface is some serious single stock risk. We're talking about a dangerous divergence. Here's how we're going to frame the next 1 to 2 weeks.
So the Fed cuts rates. Everything should be great, right? Well, not so fast. Yeah, they delivered what the market was begging for. But the real story, the one you need to pay attention to, is this incredible fragility that's building up. We've got a macro tailwind clashing with some serious micro-level landmines. Let's dig in.
All right, here's the plan. We'll start with today's market drivers, then get into the sector battleground. After that, we'll build out a strategic framework, and finally wrap up with some actionable trade setups. Simple as that. Let's jump in. Okay, Section 1, today's market drivers. Let's look at what's really moving the tape right now, the knowns and the unknowns. So here's the rundown. The 25 basis point cut. No surprise there, the market had it at a 98% probability. It was totally priced in. The real headline is the end of QT on December 1st. Now that is a big dovish signal, a clear tailwind for assets. And this is all happening while earnings are coming in surprisingly strong. But here's the kicker. The government shutdown. It means the Fed is making these calls without the last 2 months of jobs data. They are basically flying blind, and that introduces a ton of uncertainty we have to respect. Look at this number, 70%. That's the percentage of S&P 500 companies beating earnings estimates. And it's not just a beat, it's by the biggest margin we've seen in 4 years. This is the bedrock of the bull case right now. It tells you that despite all the noise, corporate America is actually performing really well. This is the pillar holding everything up. All right, the Fed decision is done, it's in the past, but don't get comfortable because the volatility events are just lining up. We've got Apple earnings on Thursday. That's going to be a huge test for the mega-cap leadership story. Then, December 1st, QT officially ends, another headwind gone. After that, all eyes are on the mid-December FOMC meeting to see if Powell and the crew stick to this dovish script. Moving on to Section 2, the sector battleground. And folks, this is where the S&P 500 is lying to you. Seriously. What's happening under the hood is a historic divergence between the winners and the losers. It's creating massive opportunities on one side and some really dangerous landmines on the other. And this right here, this says it all. We are in a tale of two markets. On one hand, you've got the AI infrastructure theme. This isn't hype, it's a real secular trend. It's lifting everything from NVDA to CAT, even a name like Bloom Energy. But on the other hand, disaster. You've got these idiosyncratic blowups like Fiserv. A 44% collapse in one day? That's not just a bad quarter, that's a full-blown crisis of confidence. It's a massive warning shot that if you're not in that AI halo, you could be in serious trouble. This is a stock picker's market if there ever was one. It's about survival. And this chart just puts numbers to that story. You see the NASDAQ 100, the QQQ, ripping higher, carried by a handful of giants. But then you look at the Russell 2000, the IWM, which is your proxy for the broader market, and it's just getting left in the dust. This is what we call terrible market breadth. It's like the generals are charging up the hill, but the troops aren't following. And that, my friends, is a classic sign of a fragile market. Okay, so with all that in mind, let's get into Section 3, building a strategic framework to actually navigate this mess for the next couple of weeks. All right, before we go any further, the standard disclaimer. This content is for educational purposes only. It's aggregated analysis from multiple public sources to help you stay informed and improve your own decision-making. You have to do your own research. This is not financial advice. Okay, here's the playbook. 3 scenarios. Our base case is that things just keep going like this. The market likes the dovish Fed, the AI names keep leading, but the rally stays narrow. The posture? Cautiously long the winners, but you absolutely have to be hedged against weakness elsewhere. Now, the bull case gets triggered if this rally finally broadens out, maybe after a strong APL report. If that happens, you increase delta exposure. The bear case, that's a hawkish Fed surprise or some kind of credit event. If you see that, you cut risk immediately and add downside protection. Think puts on IWM. So let's spell out the bull thesis clearly. 1, the Fed and the end of QT are a massive tailwind. 2, this AI infrastructure buildout is the real deal, a multi-year trend. 3, strong earnings are there to back up valuations. Now, what kills this thesis? A sudden hawkish turn from the Fed, or if one of the key tech leaders, like NVDA, breaks down. That's your invalidation point. And now for the bear thesis. It's all about fragility. This ridiculously narrow rally is a classic warning sign. A blow-up like Fiserv might not be a one-off. It could be the canary in the coal mine. And the biggest point here, what if the Fed is cutting rates because they see weakness that we can't, thanks to that missing data? That's the real bear case. How does this get invalidated? Simple. The The rally broadens, and small caps finally join the party. All right, last section. Let's make this real. We'll look at 2 actionable trade setups that translate these ideas into risk-defined structures.
Okay, first up, a contrarian play on Fiserv. Now, after a stock gets hammered 44%, you'd expect implied volatility to go to the moon, right? Well, for some reason, on the long-dated options, it hasn't. It's unusually cheap. That creates a really interesting asymmetric risk/reward. The idea here would be something like a long-dated call, say out to January 2028. It's a defined risk bet that management can turn the ship around over the next few years, and that this post-crash IV is just plain wrong. The trade's invalidated if the fundamentals get even worse in the next quarter or two. Next, a totally different kind of trade, a non-directional setup in Micron. The options data is showing a huge pileup of gamma right at the 220 strike. Now what that means is you have a massive number of options contracts sitting right at that level, which can act like a magnet for the stock price as dealers hedge. So the thesis is that the stock gets pinned there for a bit. A structure like an iron butterfly centered at 220 is built to profit from exactly that, the stock going nowhere and time decay, or theta, doing its work. Your risk is defined and the trade is busted if the stock makes a clean break above or below that 220 level. Look, no matter the trade, the process is always the same. Step 1, define your thesis. Why are you in the trade? 2, structure it correctly. 3, know your invalidation level before you enter. Where is your thesis wrong? 4, have an exit plan for your winners and your losers. And 5, the most important, size it right. A max loss should be a scratch, not a knockout blow to your portfolio. And let's close this out with our final disclaimer. Remember, none of this is trading advice. This is just a market update to keep you sharp. Markets carry risk. Always trade your own plan, manage your downside, and double-check all the data for yourself. So here's the bottom line. The market is giving us 2 completely different signals at once, a friendly Fed and some seriously dangerous internals. This is not a market for passive investing right now. It's a trader's market. And remember, the market gives you the signal, but it's your plan that provides the discipline.